Thank you everyone for coming along today. I'm really impressed to see so many people on such a sunny day where we took the afternoon off. I'm impressed that you've made it here rather than sitting out in the pub garden. So today we want to talk about the spring statement, but really I think you're all here to listen to Patrick tell us about thoughts from the Bank of England. Before we get started, courtesy of just put your phones on silent, please. I had a call from a client just out there and reminded me to put mine on silent. So today I'm going to talk to you a little bit, and then Emma's got a little bit to say, but obviously we've got a special guest in Patrick on today, who we've had a few times before, and I know always gives us some very interesting chats. The things that we're going to go through today. We're going to talk about the rise of micro-compliance, as I'm calling it. We're going to talk about the tax environment for the next tax year. Emma's going to talk to us a bit about mergers and acquisitions, which has been keeping us busy for the last few months, and then obviously we're going to have a chat from Patrick. So I always begin these presentations by giving a bit of background to A4G, but please indulge me a little bit. I'm going to talk a little bit further at length this time because we've got changes afoot. At A4G, we are very proud to be independent, and we've got this little blurb here that we're a little bit different to traditional accountants. I summarise that as saying we're a bit weird because I don't think any other accountancy firm actually works the way we do and thinks about things in the way we do. Because we always think about our clients' businesses first and operate like a business, and because we do what we preach, we think we're well placed to help in the advice we give, and it's always trying to be as practical as possible. The thing that's happening in our industry at the moment is there's a lot of private equity coming in. So how many of the top 20 UK accountancy firms do you think are owned by private equity? I'll very quickly tell you the answer. It's 35%. And the scariest thing about this is that those top 20, those private equities, and there are at least two of them, are buying up a considerable number of high street accountants. So you might think it's a high street accountant, but actually behind it is private equity. And at A4G, we've put our flag up to say we're proudly independent, we're not going to the dark side. So we own and run our own practice. The people who you see are the people who are involved in it. We have a win-win mindset, which is both for our clients and for our staff. And we are ultimately a meritocracy. I've been with the firm for 20 years, and I've grown up from trainee to where I am now because we are a meritocracy. And as I say, we're a bit weird. Most accountancy firms, you have to wait for the partner to die before you can come up with it. And we go beyond what normal accountants do. Certainly with all the M&A stuff that we've been doing recently, I've had a number of our solicitor contacts saying, most accountants wouldn't help to this degree, you're helping with this. To the point where the solicitors say, calm down, Josh, you don't want to be seen as a director. That took that one very wisely. And sometimes we care too much. Often I have to tell a member of our team who take it very personally when someone thinks, oh, this client's tax return's not going to get filed on time. They take it very personally, it's not going to get filed. I say, calm down. We can't file it for the client without them approving it. Because that's how much they care. They want our clients to have everything sorted. And ultimately, we support local jobs, which is something I'm really, really proud of. So in the last 12 months, we've taken on 6 trainees. So I'm not sure whether Patrick will talk about it later, but with the news about unemployment numbers, where school leavers and university leavers are the highest unemployment rates in the economy, we're doing our bit to make sure that that reverses, because we took on 6 school and university leavers last year, and we're really proud to have them here. In fact, Julia, who welcomed you all, is one of our last year's intake, and she's done amazingly well. And ultimately, all of this is just trying to drive efficiency so that our clients get value for money whilst having a friendly accountant at the end of the phone. So the news bit, which I'm sure a lot of you have heard, is talking about the growth of our practice. Here's a picture of Malcolm, our founding partner, in front of our current office, back when our name was Stephen Hill. We've been growing for 31 years, and we've spent a lot of time at King's Lodge, our current office. We've been there since 99, that is 99, if you couldn't tell from the time. And it's a building with a lot of history. So there used to be the Johnson's Cafe, and here's a picture I managed to find on the internet of our office when it was a biker's cafe. And it's a very, a lot of emotion in that office. Gone through a lot of life in that office, but we've now outgrown the office. And in some ways, sadly, we're going to have to move on from it, but in another way, it's a really exciting time for us to progress. And I would like to introduce you to Nepicar House. So this is where we're going to be moving to, Nepicar House. It's actually just across the roundabout from here. If you go towards the M26 roundabout, go across it, it's right there on the roundabout. So it's a stone's throw from here, really. And the big thing about this is it increases the amount of meeting space we have, and that's both small meeting rooms where we can have little Teams or Zoom calls, as that is the most common way of communicating these days, but also we get more meeting rooms where clients can come and visit us, and we always share our meeting space with our clients, so if any of you needed a venue nearby, we can offer meeting space. And the biggest thing for us is we can keep the whole team together in one location. We ummed and ahed as to whether we should have multi-location, try and, as the team grows, taking on 6 trainees, that uses a lot of desks and space. But this way we can keep everyone together and it keeps that learning through osmosis and keeping it together as one big team in one place. And ultimately, we just love the team too much. And that is an AI impression, but I have been shown the carpets have gone in and it does look pretty much like that. So it's really good. And this is actually Nepicar House. Now, we are actually in the extension bit on the side of it. We're not in the old building, but I just want to show you the old building because that's what you see as you drive in. And our current building has got history. This one's got history as well, as it was founded in 1700, I think, or something. So this is going to be our new home, and we're really excited about it, and hope we can bring all of you along on this exciting journey with us. So enough naval gazing for that. Let's talk about tax, because that's exciting. So there's a term that I've bumped into called micro-compliance. So I'm going to tell you a bit about micro-compliance. Back in 2013, the way that PAYE was submitted to HMRC changed from being these little books, you might remember, little yellow book, and you'd write on it how much tax you owed, and most people who ran their own payroll put nil on that, and would do that for 11 months, and in the 12th month would then go, oh, actually it's 50,000, and then pay that over. And some of the HMRC didn't like that, so they introduced real-time information, which means every month the computer tells them how much you owe, and you have to pay it. So that was step one. And then they started bringing in what's called Making Tax Digital, which covers a lot of different things. Making Tax Digital for VAT came in April 19, and then at the beginning of COVID, which was terrible or maybe great timing, they brought in 30-day capital gains tax returns. So if you sell a residential property, you have to submit your capital gains tax calculation within 60 days of selling the property, which is one of these things that a lot of people don't know about. It causes a lot of aggro when people don't realise this. Originally it was 30 days, but as it came in during the middle of the first lockdown, not many houses were selling, so not a lot of people realised. They now extended it to 60 days, realising 30 days was too short. And then from April coming, we go into Making Tax Digital for self-employment and landlords. And then we've got another step to this after here, so one to look out for in April 2027, although this has been delayed twice at least already. They're going to change the payment in kind system, so you now have to put your company car and private medical onto the payroll and it will be taxed each month rather than through the tax code that HMRC get wrong all the time. And just for the record, MTD was announced in 2015. It's taken this long to get in place. So I'm not going to labour too much on this because we've only got limited time. But in case you need to know it, these are the deadlines for making tax digital submissions. So if you've got rental income or self-employment income, you'll have to submit quarterly submissions through software to HMRC, and these are the deadlines for everyone. Everyone's got the same deadlines. There's about 1 million people who will be in this system, so I am concerned that on the 7th of August that system is going to collapse with its first batch being done on the deadline day. This is being introduced in a tiered fashion, so only those with combined self-employment and rental income over £50,000 are going in the first wave. Then from 27, 30,000 is the next wave, and anyone with income above 20,000 will join from 28. No plans to go below that. That's all I'm going to say about Making Tax Digital for now, but if you want to know more, we do have a landing page here. I've recorded a really exciting video that gives you more information and our best advice. The way we're approaching this is we want to give as much information to everyone as possible to help yourselves, because if you've got rental property, you really don't want the costs of having to get bespoke advice on everything if you've only got 1 or 2 properties. So the idea is to help everyone help themselves, and then when you get to the point, I need help on this bit, we can come in and go, right, this is the specifics that you're going to need for that. And here's our little checklist of things to do to make it digital. So please visit that, and we'll be updating that as more and more comes out as we go into it. So now let's talk about the new tax year. What taxes are changing? Well, as I spoke about after the budget at the end of last year, from this 6th of April, the tax rates are changing for investors, although HMRC consider limited company owners investors. It's actually going to affect quite a lot of small businesses who are managed. But let's first look at the increase to taxes on residential property. So everything's going up by 2%, all three tax bands, which ultimately means if you've got about £20,000 of profits from your rental property, it will see an increase of £400. So it's not the worst tax rate it could be, but it's still, when it's a margin-based investment like property is, this isn't very helpful. One thing that I do want to point out though is that interest on residential mortgages, whilst it's not tax deductible in full, so it won't save you if you're in the high rate band, it will still get you 22% tax back on just the interest. Complicated way that goes on tax return, but that's the summary of it. Now, for dividends, these are considered investment in terms of how the tax system is written out. But obviously, most small businesses run with a small salary and the rest they're paying as dividends. And in this case, they're increasing by 2% the basic rate band and the higher rate band, but they're leaving the additional rate band where it was. What I find quite annoying is I hate these decimal points that they've got on these rates. Why they didn't round it off, I don't know. So I still got to store all this in my head as well as the old rates, which still have decimal points in. Now, this is a much bigger impact to small business owners, that if you've got £100,000 of earning from small salary and dividends, actually your tax will go up by about £1,750. So this is a much bigger dent on that. The next question that this poses, though, is what's better, dividends or salary? This is something we get asked quite a lot. So let's look at the numbers. So if you have a gross pay of £100,000 for accommodation, small salary, the rest of it's dividends, you would net income of just over £79,000. This is the tax from the company bit is zero because dividends are paid after corporation tax. But if we compare that to a salary, so you're taking the full 100,000 as a salary, it would save just shy of £20,000 of tax for the company. That's it, after accounting for increased employers' national insurance. However, although you've got a significant saving for the company, you do have quite a big hit on your net income because you're exchanging company tax saving for an increase in personal tax rates. So as you can see, 100,000 on PAYE would get just like £32,000 of tax, meaning your net income through salary is much lower than it would be if you took all your money as dividends. Even if you put that near £11,000 saving into the salary to top it up, it still doesn't quite match up to the net income. So it says to me, dividends and small salary is definitely still the most tax efficient way to draw. A top tip that we've got is if you've got profits that allow you to draw a dividend up to £100,000 of total income, but you haven't yet done so, it might be advisable to get advice to see whether it will save you a bit of tax to just top up to the 100,000 mark before the tax year ends. Right, so now moving tax, some other tax changes that are coming in. Well, they're coming in and they were just changed just before Christmas. Agricultural and business property relief has been semi-reversed, well it's not reversed but softened. So the farmers all marching on Parliament, they decided just before Christmas that the £1 million cap on IHT-free agricultural business property relief would now be 2.5 million. I don't think it stopped any farmers marching on Parliament. They've increased it. Anything that's in someone's estate from agricultural business property is then taxed at 20%, so half the value of full IHT, but still more than zero as it was before. Now, one thing that we've seen in the draft legislation is that the 2.5 million is a per person allowance. And what this means is that spouses pass on the 2.5 million allowance if they die first to their surviving spouse, which means effectively it stacks. And that means that between spouses, they've got a £5 million allowance for business property, which now starts to sound a bit more useful for a number of businesses. But this is, the team have told me this is what's in the legislation, they're happy with it. I haven't seen it tested, and obviously the tax hasn't come in yet, so we'll see what happens in the real world. But this is what they're telling me is how it's going to work. And then another thing to bear in mind, not happening yet, but happening from April 2027, is pensions are due to become taxable in the inheritance estate. But obviously we've just seen a slight U-turn with the business property relief, so there's still that little bit of hope that they will change these. As I think this is such a huge change to the inheritance tax system that it's one of those things that the closer you get, the more scrutiny it will come under. And then the last thing I want to talk about is business asset disposal relief. So we've been very, very busy recently because capital gains tax rates for business owners, so if you're selling your own business, it's going to go up by 4% from the 6th of April. So that means that there's a big wave of small businesses trying to sell. I've seen a big wave of management teams saying, oh, do you know what, I'll buy it off you now before that tax rise comes in. And it's just been, every solicitor I've spoken to seems to have been extremely busy recently, as well as us. And there's a lot of, we're also seeing that EOTs are still being used. There was a little bit of cutting of the reliefs that an EOT gets, but we're still seeing those a lot in the market. But what we're also seeing is a lot of foreign investors being interested in buying UK entities. So possibly it means that the future looks bright. However, I'm usually very against making predictions for the budget, but one of the tax sources who I often get CPD training with was very much saying that they suspect the capital gains tax system will be tweaked further in the autumn. And usually I don't say these things, but the fact that they were saying it makes me think I should tell all of you. So maybe we will continue to be busy with sales as people try and beat any other changes they're going to try and make. So we've been very busy with mergers and acquisitions, and now I'll hand to Emma, who will tell you a little bit more about what we're actually doing.
Thanks, Josh. I will tell you a little bit about the mergers and acquisitions market, but what I would say is for many of you in the room, if you're thinking actually mergers and acquisitions is not for us, we're not looking to sell, I do always believe it's a bit of a mindset as well about maximising what you're achieving from your business. It is an incredibly active market at the moment, from foreign investment, but also within. I think the costs of running a business have gone up quite a lot now, and so people are wanting to sort of stack turnover to make that worthwhile, really. I'll be interested to see whether it's still showing optimism for the future, but as I say, I do think it is a mindset, and it's a good one to get into as a business owner. But a lot might depend on access to lending for expansion and growth. Typically with the acquisitions that we're seeing deferred consideration, so upfront deposit with deferred consideration, but for a lot of those businesses to actually repay the deferred consideration, they might need to grow the business. So there's some really interesting things going on in the lending market where there's some quite innovative products and stuff, but it will be interesting to see how interest rates and things affect that. And obviously the employment market, certainly for talent, experienced talent, is becoming quite tight. So you are seeing that drive some of the sort of acquisitions that are going on because people are effectively buying those skilled labourers within another business. So I do think that is going to continue. I was talking to a recruiter this morning actually that are saying just how challenging it is for certain roles. So I'm just going to run through quickly some of the common things we're seeing just to give you an idea. We are seeing valuation expectations. So sometimes people have an unrealistic expectation or a valuation that has been plucked from the air in terms of what they might need to retire, but actually it not worked back to what that means from what their accounts are showing. So for many of you that don't know, most SMEs are sold on a multiple of EBITDA. And EBITDA is earnings before interest, tax, depreciation and amortisation. A lot of people look at their accounts before dividends and think, oh, actually, I've got a good profit, so that's a multiple, that's how that works. But actually, one of the things that people tend to forget is actually the need to normalise EBITDA. A lot of buyers are looking for a turnkey business where they don't actually have to step in and deal with the day-to-day running. They actually want a business that's going to operate on its own. So when I talk about the need to normalise EBITDA, what I mean is if you are a director doing certain roles in the business, you've got to take the cost of that out of the profit on the accounts to see what it actually truly is worth to an investor. And sometimes that also includes rent. If if you're the owner and you've got a property and you're using it rent free, again you need to adjust for the new owners to be paying market rent on that. And then part of the exercise of looking at valuations and things is looking at where the business can be pruned, some of the expenses, cut unnecessary costs. There's a very different set of accounts when it's a lifestyle business. People might be employing their wives, there might be 2 family cars running through the business, things like that. Children might have summer jobs, and all that type of stuff is things that we clean up early if you are interested in a sale. So my recommendation really is if you are on that mindset or you are thinking of your business like a pension, you're going to realise at some point you should be looking at having a valuation done at least 3 years out from expected sale. The reason I say that is because often once you start talking to buyers, it happens quicker than you expect. So it's good for you to have an idea what are the things that drive your valuation of your business. Over-reliance on the owner is absolutely critical when you look at the business. If you are irreplaceable, you're either looking at a really long time handover, which quite often when you get to the stage of sale, you're not really willing to do that, you're looking to retire, or it might just make it completely unviable. If there's a management team that are making decisions, are helping with the day-to-day running, that gives the security to the buyer and actually improves valuations and multiples. So what I would say again, big tip, just review the dependence on you. Sales, particularly the sales model, operations and finances. But it's a good exercise for you, for anyone that likes to take their laptop on holiday and work throughout their family holidays with kids and wives mainly. It's a really good exercise to get into, just constantly think how you can pass some of the responsibility down. Poor bookkeeping. We see some really unreliable data, and it does mean you're beaten down on price, or they want to be, if they're worried about skeletons, they put huge warranty claims in share purchase agreements and things. And what warranty claims do is, for a new buyer, even if you said to them that liability to HMRC is not right, or this isn't right, they're not going to give you the time to look at it because they've got good warranty claims where they can just claim back the money from you. So they will pay whatever debt they get asked for and claim it back from the seller. So, having tidy books means you can push back on the levels of warranties in contracts. And I'd just say remember the balance sheet is important. I think a lot of people spend time tidying up their sort of profit and loss and expenses, but actually we see some sort of messy balance sheets, unclear transactions, old assets. So it's good to have, know that your balance sheet reflects the true value. Lack of contracts is quite key. We see a lot of businesses with over-reliance on big customers without contracts, or just no contracts at all, particularly covering risk of cost increase. Someone mentioned it to me earlier, if you consider cost of fuel has just gone up, if that's, if you're a haulage business and that's not covered, that is significant. So good contracts help protect the business, but they also give security to a sale. And actually buyers tend to like sort of more boring businesses where there is a guarantee of repeat work. Certainly lack of employment contracts or staff handbooks. You'd be surprised how common that is, which means there's just a complete unknown risk. The unknown risk is effectively if you've been allowing your staff to do things for a period of time, there's a contractual agreement, it's just not in writing. And obviously again, all of those things would be covered in a warranty, so you're just liable for them. So, but it's all good sort of practice really for businesses to have these things in place. So get it in place nice and early. Untidy, unclear business structures. So sometimes you see complaints or legal issues that have been dragging. Again, you need to close things like that before going to sale. But also what you sometimes see is old or silent shareholders, and they can be really minority shareholders, but buyers aren't interested in dealing with it. Obviously, the earlier you deal with that, the better, because if you're trying to deal with that when you're in sale negotiations, suddenly your 2% shareholder is getting a lot of money for their shares just because you need them to go away. So again, it's just good to tidy those things up, even if they are historic issues. And traditionally, companies had a book with the share certificates in, share registers and things that got handed down. Obviously, where everything's digital now, that doesn't happen. But the first thing people will do is do a sweep of Companies House to see who's on there as directors, shareholders, secretaries and things. And you need to have the history of that as well. So it's good to get that tidied up and make sure that it's handed over if you're changing accountants and things. One of the things we often do with our clients is a session called What is My Business Worth? Now, we do that not necessarily just for M&A, we actually end up doing it quite a lot for inheritance tax planning, but it's a good exercise to know if your value of your business is going up or down, because it gives you an opportunity to change that. So we base our valuations on 3 years, and we look at 4 different valuation models. So it gives you a really broad range and an understanding of what things impact the value. And then we have interactive discussions with our clients about what drives the value of your business. And that's why I say it's a mindset, because actually if you're doing all the things focused on M&A, often it means you can make the business less dependent on you, and it might be that when you come to a sale negotiation, you realise that you've got a good management team in place who can actually run a lot of it for you without you having to work your 2-week holiday. And we have a lot of improve and grow sessions we run for our clients, and for any clients in the room, I know a lot of our meetings end up with notes of meetings with blue action points in bold for who needs to do what by when. So it's very clear what happens as a result. So I thought that would just be a nice little update about M&A. I am hoping they don't touch capital gains, because I am quite sick of working really hard for a tax change deadline on trying to get sales through without clients making compromises. So I'm going to now hand over to Patrick, who hopefully is going to enlighten us.